Good morning, everybody. Welcome to the ARMR Report. This is the morning meeting. This is a show about stock market investing. We use the combination of fundamental analysis and proprietary algorithms to create alpha, protect capital, and capture upside when appropriate. So this is about both trading on an intraday basis and then building portfolios and investing over multiple days, months, years. The morning meeting is designed to get your mind right to trade the day and to discuss just a couple of things that are happening on our trading desk that we think are important. Let's not forget this is a live trading desk. I'm managing my own capital and that of high net worth investors. All of our portfolios are run through Interactive Brokers and our affiliation with them. And so I'm going to keep this brief. It's a morning meeting. It's just to give you some thoughts, some insights about how to get your mind right to trade this morning. And then, of course, at 12 o'clock, I'll be back on to discuss in broader detail what we're seeing using our algorithms. But to start, I just wanted to say and kind of remind you what we think about every day, our mantra on the desk. Every trade we make, every investment we build in our portfolios, we start and we end with the following two questions. Are we getting ourselves on the right side of probability and statistics? And is the reward worth the risk taken? If statistically speaking, we're on the right side and using our algorithms, we determine the reward's worth it for the risk that we have to take, then we commit capital. It's really that simple. That is the equation you need to constantly check before you click a button to make a long-term investment or a day trade. It doesn't matter which. We use algorithms to do it. Algorithms are designed to help us get on the right side of probability and then gauge what the potential gain off of an investment or a trade can be versus what risk we have to take to capture that gain. That's what everything comes down to. Whether it's a short-term trade or a long-term investment, that's what it comes down to. And the opportunity cost of money is important. So as I've been saying the last week, I think we talked about this briefly, but I'll just share this thought with you again. Do I invest in cannabis stocks at the beginning of an investment super cycle for these companies? Or do I buy General Motors? Do you see what I'm saying? The opportunity cost of money here over the next 3 to 5 to 10 years, you can either invest in a cyclical business where the stock never really goes anywhere. It goes up, it comes down, goes up, it comes down, because it's going through a cyclical business with a lot of competition. Or you can invest in companies with a lot of intellectual property in an open-ended business opportunity, such as cannabis. And then you can look out 3, 5, 10 years and say, there are unlimited rewards to that investment. And the risk is going to be the same. I'm going to put capital to work. I'm going to have a stop loss, whether I'm buying General Motors or GE or a cannabis stock. If it goes down, I'm going to cut my loss. I'm going to take my loss. I'm going to step aside, look for the next opportunity. But if our entry's right, there's multiples you can make on a cannabis investment versus owning shares of General Electric. I rest my case. Now let's get to day trading for a second. We like to invest, we like to trade the indexes. We use exchange-traded funds, SPY, DIA for the Dow, QQQ for the NASDAQ, IWN for the small cap. We focus on those four, and we follow the momentum index, MTUM, for a longer-term perspective on the market. I'm going to share my screen with you in a second so you can see what I'm talking about. Today is a gap down morning. We're looking to gap down more than 0.5%. That's a good gap down. That's going to be compelling. I usually like to get long. You guys have been following me know I look to go long gap downs and short gap ups. Because right there, just based on that alone, I'm on the right side of probability. Statistically speaking, when the market gaps down, it tries to close the gap during the day. It tries to go back to the VWAP. Does it do it every day? No. Do I just buy a gap down? No. We need specific triggers to get us to go long, and we have to use the correct stops. And we have to use the right targets. So as we go higher off of that gap down, we're booking profits, we're raising our stops. If it wants to keep running, we let it run and make as much money as we can. If it wants to reverse, we book our profits, say thanks for playing. Okay, so let's get our mind right for this morning. Gap downs of more than 0.5%, particularly 1% gap downs, really can set up great reversals. Now, that's on the one hand. On the other hand, you all know I've been stalking the bear now since September. So we're right up against major resistance, major downtrends. I don't like the fact that everyone's talking about it on CNBC. So maybe the market will go higher and, confuse everybody. But it does look like the market should retest. Okay? So we are getting a gap down this morning, and the way it trades today is going to be very important. If we close near the lows of the day off of the gap down back into the downtrend, we're going to want to be building our short positions. This is kind of what we've been waiting for. I like gap ups that reverse. That's kind of what I was hoping for. But the market never does what you hope. So you have to just read and react to what you're getting and understand the behavior. So far, these gap downs in the last 12, 13, 14 trading days have always led to higher prices. So buying the reversal off a gap down has been a money trade. And let's follow that today unless we're proven wrong. Tight stops. If it works, it's going to rip higher. We'll make our money. There could be two trades today. Could be short in the morning, rips higher, puts in a top, and we're short, long in the morning. Sorry, it rips higher. Right? We book our profits, tops out, sells off in the last couple hours of the day. We might be short right up there. We could be doing two trades today. But let's take one thing at a time. Gap down of more than 0.5%. What we're looking for is a chart pattern like this. I'm going to share my screen so you can see this. Okay. What you're looking at is the NASDAQ 100. Down here, you can see my hand moving. Okay. Down here, this yellow box just highlighting. This happened on the 17th. This is last week. This black dots right here, the volume weighted average price of the previous day. This black dot is the gap down open. These green dots tell you that there's volume trading on that gap down open. So this is an extreme volume reversal that we love to buy. Market gaps down on a lot of volume. When we close above the high of the first big volume bar, we didn't close above it here, but we do right here on that third bar. That's the bar we're buying because it proves that the big volume down open is being bought. And of course, it rips higher. You're going to book some profits right at the previous VWAP. You're going to use today's VWAP as your stop. And of course, you bank out at the end of the day. Okay, now this is a RCM VWAP. So it is proprietary to what we're doing on our trading desk. You can't duplicate this. These are Fibonacci extensions above and below the opening range, all of which are proprietary to our algorithm. But suffice it to say, this is how we trade. On a gap down morning, we look for volume. We look for a close above that volume. Then we look to get long. I'm going to just scroll forward here. We're going to look at Friday. Look at this trade. Okay? Just to give you an idea what happened. This time we gapped up, right? Volume bar on the gap up. So in this instance, what you want to do is you want to short the first close below that gap up, a close below. It came down, tried to, and then of course it reversed. So that trade didn't make you a lot of money, but you didn't lose a lot of money either. We're on the right side of probabilities and statistics. We had some extension in our favor. We booked a small profit. It comes back above the VWAP and we're out of the whole trade. And for those of you who are more advanced, you can get out of a trade that's not going your way and flip and go the opposite direction. Because when this trade doesn't work, it almost, statistically speaking, puts you in a very probable position that it's going to move higher the rest of the day. And this is what it does. That's for aggressive traders, though. It's very hard to do both. My point for this chart is that we had a gap up that tried to close the gap. When it failed, we had a small gain. We book here. When it comes back above the VWAP, we're out of the rest. Relatively break even on that whole position. So our risk was limited. We go back to this day. Same situation, the opposite. Gap down, put a position on. The stop would be the opening range low. It never challenges the stop. And you have a huge run at the end of the day. Okay, guys, here endeth the lesson. Thanks for listening. I'll look to talk to you again at 12 o'clock. Good luck today trading. Be safe out there. Only hit your pitch. Take care.